Turning your spare room into tax savings sounds great, but one wrong checkbox can cost you hundreds. The home office deduction is powerful and picky. Use it right and keep more of your money. Use it wrong and invite pain later, especially when you sell a home. In this quick guide, you will learn the simplified versus regular methods, direct versus indirect costs, and the recapture twist for renters and homeowners. The home office deduction lets you write off the cost of the space you use for business at home. Think of slicing a pizza. Your office slice gets business toppings. It is for your principal place of business or a space where you meet clients. The catch: it must be used regularly and exclusively for work. Exclusive means no guest bed, no kid homework, no Peloton. If your laptop floats around the house, that space does not count. There are two ways to claim it: the simplified method and the regular method. Both start with a legit exclusive workspace. Simplified is a quick per square foot shortcut. Regular uses actual bills and percentages. We will compare with numbers so you can pick like a pro. One more concept: direct versus indirect expenses. Direct fixes your office only. Indirect keeps the whole home running. Who qualifies? Self-employed folks filing Schedule C, single-member LLCs, and many side hustlers who truly work from home. If you are a W-2 employee, this deduction does not apply to you. The One Big Beautiful Bill Act made that suspension permanent for 2026 and beyond. Self-employed only. S-Corp owners on payroll are employees of their own company. They usually need an accountable plan reimbursement, not a personal home office deduction. Renters and homeowners both can qualify. The math changes a bit, and homeowners have a special rule on depreciation we will unpack. Start with square footage. Measure your office area and divide by your home total. Example: 150 SQFT office in a 1,200 SQFT home is 12.5%. Simplified method: $5 per SQFT up to 300 SQFT. In our example, 150 SQFT gives you $750. No receipts required for home costs. Regular method: multiply indirect bills by 12.5%, add any direct office-only costs at 100%, and include depreciation if you are a homeowner. Direct expenses include repainting the office, fixing its window, or replacing the office carpet. Those are 100% business. Indirect expenses include rent, mortgage interest, property tax, utilities, HOA, security, and insurance. Multiply each by your business percent. Regular method uses Form 8829 to flow to Schedule C. Simplified skips Form 8829 and goes straight on Schedule C line for home office. Numbers time. Say annual indirect costs are $24,000 total. Rent $18K, utils $3K, INs $1K, other $2K. At 12.5%, that is $3,000. Add a $200 direct paint job for $3,200. Compare with simplified $750 from earlier. Regular wins in this example. But the winner can change with your size and bills. Homeowners only. Depreciation under the regular method. You write off the business share of your home over time. This lowers your basis and can be recaptured later. Mistake: claiming your kitchen table. The exclusive use test fails. Pick a defined walled area or a clearly marked section used only for work. Mistake: double counting internet or phone. Only the business share counts and do not count it again somewhere else on Schedule C. Mistake: forgetting the gross income limit. The home office deduction cannot create or increase a loss. Extras carry forward with the regular method. Mistake: mixing simplified and regular in the same year. You pick one per year per home. You can change next year. Mistake: calling a big remodel a repair. Improvements are handled differently and may be depreciated, not fully expensed at once. Mistake: not tracking square feet with a simple sketch or photos. If asked, show your layout and measurements. You can switch methods each year. If your bills jumped, regular may shine. If you moved mid-year or bills dropped, simplified may win. Homeowners planning to sell soon, simplified avoids depreciation and future recapture. Regular gives a bigger write-off now, but can bite later. Recapture basics. When you sell, any home office depreciation taken after 1997 is taxable up to a special 25% cap. It is not covered by the home gain exclusion. S-Corp owners. Use an accountable plan to reimburse home office costs. Treat yourself like an employee and keep a simple worksheet each month. Daycare providers have a relaxed rule. Exclusive use is not required, and you use a time-space fraction. See Pub 587 for the formula. Selling goods from home? Storage of inventory may qualify even without exclusive use, if the space is for storage and your home is the only fixed place of business. You can use rooms instead of square feet if rooms are about equal size. Pick one reasonable method and apply it consistently for that year. Action 1. Map your office boundary and measure it. Note total home square feet from your lease or appraisal, or measure rooms and add them up. Action 2. List 12 months of indirect bills and any direct office repairs. Split internet and phone between personal and business use based on a reasonable ratio. Action 3. Run the math for simplified versus regular. Pick the higher deduction, but remember the depreciation and recapture trade-off if you own your home. Action 4. File it. Simplified goes on. Schedule C, regular, goes on. Form 8829, which then feeds Schedule C. Save your sketch and receipts in one folder. Want the next step? Watch Schedule. See Explained for Freelancers, then check what is an S-Corp to see when an accountable plan makes sense. Subscribe for daily taxes explained.